Some recent research that we did in the UK suggests that 1 in 6 claimants from an insurance policy goes into debt waiting for their claim to be paid.
Yeah.
Which I found absolutely staggering, that a company would actually delay the payment to the extent that they're impacting the credit score of their customer.
Welcome to Adyen Presents, the new Treasury standard. In a modern global economy, complexity should never be a barrier to business growth. Yet for many leaders, the friction of legacy systems has become a silent bottleneck. In this special 2-part series, we're joined by Adrian Davis, Managing Director of Financial Services and Insurance at Adyen, and Alec McLaurin, one of Adyen's senior commercial business managers, to discuss why Treasury is no longer a back office function, it's on the front lines of innovation.
We've seen in the research that Adyen's conducted with BCG that there's a tremendous amount of complexity in the average company's treasury setup, right? We're talking about 40 different bank accounts, 5 or 6 different banking partners, 12 payment providers. Where does that kind of fragmentation and complexity come from?
I'm not sure lots of different banks add safety. I think they're a product of accumulation over a period of time. I think if you're a modern global enterprise, you kind of build up these relationships over time.
Yeah.
I don't think it's intentional. I think it just happens. Yeah. And I think with something like that, it's not often that the CFO takes a minute just to take a step back and think, actually, if we were building this today, we would do it in a different way.
Yep.
And sometimes there isn't that kind of burning platform or that catalyst to do that.
Yeah, and I think that's what we've seen, right, in the industry amongst corporates, that gradual accumulation of financial partners to solve for a specific problem. The issue with that is, how do you coordinate and orchestrate that build-up? How do you ensure that all those different components, all those different financial tools are actually speaking to each other? And how can you maintain that visibility on a daily, minute-by-minute basis? Which I think this gets us really into the challenge that we're starting to see in the corporate treasury space of the accumulation of partners because of a specific need.
I agree. And I think, what does that fragmentation bring? Well, I think it certainly traps a lot of capital. We see that with our customers. It might just be a day here or a day there, but if you multiply that across a number of different financial institutions that you're using, then that money isn't in play for you. You don't have the opportunity to either pass it to your customer quicker or do something more productive with that cash, like get a return on it. I think it's also, number 2, I think it's costly. To have a number of different banking suppliers and to have to monitor those and to manage those, all the different logins, that's complicated. That brings real cost to an organization. But I think the third point for me, and I think we're hearing this more from our customers, is if I sat on a risk committee and I was looking at my financial infrastructure and the banks that I was using and the fintechs who were lending someone else's banking license, and if I looked at that in aggregate, I would see a lot of risk. I wouldn't take comfort from that. I know that for many organizations, having more than one bank is sensible from an operational resilience perspective. But actually, as I say, in aggregate, that constellation of lots of different banks and fintechs using other banks actually all adds up to quite a significant level of information that the risk committee doesn't know. For example, if you're using a bunch of fintechs, do you actually know whose banking license that they are reliant upon? So to what extent is your business reliant on entities that you know, that you've met, that you trust and have your best interests at heart, or are they hidden in the background?
I think that perfectly speaks to the challenge today of developing and trying to automate the right workflows that you need to practically do as a treasury manager, the practical jobs to be done of, hey, I need to ensure I'm able to make the payments that I need to make, I'm able to manage the AR process, I need to set up for my business. But you may be buying a provider or buying a solution that's providing you the right UX layer, but the underlying financial infrastructure is dependent on another entity, on an external bank that might have a different appetite from a risk perspective than that UX layer that sits on top.
I think, as we know, there's some very attractive software solutions in the market that can aggregate much of this, but they can only aggregate the plumbing that's sitting underneath all of that. And if you are reliant on 40 banks, for example, which our BCG survey suggested that many large complex enterprise organizations are, then your ability to move money around intelligently through that constellation of different financial institutions is quite clearly impaired.
Yeah.
And I think, crucially, it matters for two reasons, because if you can't measure it accurately, for example, if all of those banks aren't integrated into your TMS, then you can't really make the sort of decisions that are optimized because you don't have the right information at hand.
Yeah. And it comes back, I think, to some of the fundamental core concepts of treasury management. There's still a big emphasis on having visibility of liquidity and being able to optimize that liquidity. So there's two kind of central challenges of visibility. How do you practically construct that? And how do you identify those kind of contingent value chains or chains in the supply chain of finance? We had a client describe it as the Bullwhip Effect of finance, of one delay in part of that process can amplify the consequent delays in terms of actually getting access to funds and actually deploying them or providing them to the end user or to the business that you're working with. So those kind of central points of friction and fragmentation in that value chain are really constraining or having an effect on that visibility of liquidity, and then obviously impact the ability of a treasury manager to optimize the utilization of capital.
You're listening to Adyen Presents with Adrian Davis and Alec McLaurin.
I think it all does come down to seeking to enhance that financial performance. If it's all fragmented, if you can't see it, if you can't manage it properly, you're increasing your cost of capital for your business. And I think what I've found interesting is working closely with some of our customers is that if you sit down with them and map some of those money flows through the organization, even they're surprised how often money is just sitting, waiting to get settled or parked in a bank account, waiting for further instruction. And if you aggregate all of that together, then not only are you able to make the flow of cash a lot more effective, but your ask in terms of working capital is reduced significantly. So it's not something that's a nice to do or a nice to have. I think it's absolutely fundamental to how companies can improve their financial performance.
Especially from a perspective of automation, we're all seeing how in every function right within a company, there's a big drive to look at automation, look at the impact of AI, right, to improve the capabilities of those functions, of what they can do, of how efficient they can be. And I think treasury management is a great example of an area where there's a huge scope for automation, but also some of those kind of structural challenges, right, in terms of being able to effect a change on those like practical money flows and ensure that you're able to connect the dots, right, across your organization and across how money moves in and out of your organization.
I think automation in Treasury, and I think increasingly we're going to see more AI agents within Treasury operations. I think that's very exciting because the potential benefits for customers are significant.
Yeah.
You can intelligently make decisions, while people are sleeping, to sweep certain accounts or optimize the rate of return that one's achieving. And I think that future is very exciting and very compelling. However, if that's just a veneer over the top of a system that's too complicated, that doesn't work and isn't efficient, it's not really going to create the value that people expect.
Yeah, and I think we see that in the research we did with BCG, right, where still 20% of payment flows, of pay-in and payout flows, need some format of manual intervention. There's still that friction point, right, of a physical person needing to approve a payment, needing to review a payment cycle, needing to initiate an invoice. And that's a reality of the current structure of how finance teams operate. A lot of that makes a lot of sense because there's a lot of complexity to manage those rules, manage, what's your purchasing policy, who needs to approve a new vendor, right? Bringing that into more of an automated or AI-driven workflow is challenging because it needs to learn from that experience. Again, in our research, we see that 20% of all pay-in and payout flows that finance teams manage need some format of manual intervention. Is that a structural issue within finance teams? Is that a failure of how they operate, or is there something more structural behind that, more inherent with the actual function of the finance department?
I think a lot of that is dependent upon the size, the maturity, the sector that the organisation operates in. But I think what's increasingly clear to us through the research that BCG have done for us is that many organisations are operating with a financial infrastructure that resembles something that would have been fit for purpose maybe 30 or 40 years ago. That operating system from 1976 is not the same as what's needed in 2026.
I completely agree with that. And I think it also speaks to some of the shifting behavior we're seeing, especially on the AP side, where I think traditionally a lot of finance departments have been really negotiating and managing that AP flow to delay as much as possible money flowing out of the organization, which makes total sense from a working capital perspective. What we're starting to see now is AP teams, finance teams, treasury teams look at, hey, can we actually create a better experience for our customers and suppliers by improving how we manage AP and how we can automate it into our product and into a contingency based on, for example, a drive or a taxi ride being completed or a parcel being delivered, to avoid, again, that friction of having an individual having to manually execute a payment.
And I think that points to one of the most interesting observations that BCG have made through this joint research with Adyen around the role of the Treasury team. Because as you say, actually the Treasury and the finance team should be having more of an influence over the company's business model and how it operates and how it interacts with customers or perhaps third parties such as a delivery company with their couriers, and thinking more innovatively about how they can monetize, perhaps paying people quicker. And all of that is very different to, I think, the traditional way that a Treasury department is probably thought of. And I think it's a really interesting challenge alongside many of the enabling technologies for these Treasury teams to really mark out a different future path for them and contribute even more to better performance in the enterprise.
To find out more about the Treasury Innovation Report, written in partnership with Boston Consulting Group, check the show notes for a link to the full report.
I think for me, that's one of the most important takeaways from the report and from the conversations we've had with clients around this topic, that the Treasury department, the finance department can actually work hand in hand with the rest of the business to actually deliver on the business's goals, on driving better experiences, better NPS, and better outcomes for the whole value chain of how the business operates.
And I think this new model for Treasury, I think, is entirely appropriate when we see the speed of business that our customers see in a variety of different market verticals, particularly in financial services or insurance, where, for example, a broker needs trades to be made immediately, and payouts need to be made at an appropriate point in time. This speed that digital natives expect from their products and their services that they buy, the expectation is far higher than it was even 5 or even a couple of years ago, and the Treasury department needs to respond to those sorts of challenges.
Yeah, we're seeing that kind of expectation from a consumer perspective of making a payment, wanting that payment to be executed seamlessly. That expectation translates to receiving cash, right? So when you're signing up to a platform or when you're working as a broker, for example, and you want to cash out of your position, you want that experience to be seamless. You want to get visibility of when you're going to get your cash, and you want control over that notion.
Some recent research that we did in the UK suggests that 1 in 6 claimants from an insurance policy goes into debt waiting for their claim to be paid.
Yeah,
which I find absolutely staggering. That a company would actually delay the payment to the extent that they're impacting the credit score of their customer. That does not seem like a logical way to treat people.
Yeah, and I think in the insurance sector with parametric insurance, right? I think we're seeing a lot of actual potential with more of these flows and using AI workflows to actually enable that payout experience and to enable the contingencies of a very clear event has happened, it has been proven, that can automatically unlock an action or a policy decision, and then the payout has to come straight away.
And the payment is front and central to all of this. This is where the money flow into the organization starts. And that's why I believe Adyen are well placed to be able to help companies with this challenge. We see the money as sales are made potentially quicker than our customers can actually see that themselves. But then we can also connect that to, for example, where the customer needs to do payouts and make that seamless. So there's not you're not pooling a load of money into a bank account with a vague notion as to how much the payout should be. You've got a read across. And also you've got a single point of view of the customer as well, because you might take their card details, and those card details can be used for acquiring, but also for the payout at the end too.
Yeah.
So we've talked about the fragmentation today. How do we move to a more unified view of money movement?
Yeah, I think it's a big challenge. I think we shouldn't understate how processes around money movement at a Treasury and CFO level, it takes a lot of involved work and a lot of close collaboration with partners. I think one central theme is, from a financial partner perspective as a corporate, who can help you get that visibility that you're looking for? And how can you start to identify and think of flows or money movement from a horizontal layer? So instead of looking at isolated pillars or isolated groups of financial stakeholders that you work with, how can you identify the right partner that has that capability of tying a flow end to end? And then figuring out with your business teams and your core internal stakeholders, what is the priority? Where should I actually focus my time? What experiences do we want to start to build out? And then gradually layer that into your process and into your products. So I think there's really that central theme of, hey, how do I get better visibility of money movement? How do I get a better understanding of the blend of partners I have currently or that I need to work with in the market? And how do I start to create that experience that can support what my business actually wants to deliver?
I think it's acknowledged that there is no one silver bullet to solve all of this.
Yep.
It's complex, it's multi-layered, it's fragmented, as we found out. Organizations often rely on a number of different third parties to perform this, and that can't be reformed overnight. But there are still providers in the market like Adyen who can unify that payment flow from acquiring all the way to payouts and all that money movement in between. The advantage being is that you're dealing with one platform where you have full visibility of your money wherever it is. And of course, our banking and treasury services are underpinned by our banking license, so we can offer accounts and other services to again increase the effectiveness of your money movement.
This podcast is brought to you by Adyen, a recognized leader in the 2026 Forrester Report for merchant payment providers. Check out the report at adyen.com.